Hi, everybody. Welcome to class today. It's Tuesday, December 16th, and we're just about ready to get into our next topic, which we're going to move over to business math and talk about some of the things that are in there. Before we do that, I wanted to touch on a couple of things. I believe they're in week 8 profitability ratios. I know these are not ideal. Just as a reminder, these little like images or whatever it is, this type of text, very recent change. It's all about our technology and learning center making sure that everything in our online classes is accessible. It's called accessible, just means like anyone, regardless of learning type or style, can read it. And so this is basically a note to the instructor, to me, to that they're saying, oh, these are no longer acceptable, and you got to change them. So that's new for this fall. So forgive me, I didn't change them, but I did want to say a couple things about those. Um, um, what is that? I can't open that. Okay. All right. So here, we talked about profitability ratios. We did the profit margin and return on assets. And then it says, can other ratios be used? So remember that, and I know this takes forever to pull up, but remember that in the principles of accounting text, I showed you like a whole list of where is it at? It's actually here. A whole list. The link in that reading from last week took you to a page here that had a list of like, I don't know, like so many different oh, so many different ratios. Hold on. What? Hmm. You can't open Zoom if you can't open Zoom, but you're in the chat. How is that? It could be like the window, like I can't, it's hard because you can't see it on my screen, but you know how we have these little like thumbnails? They're little like boxes with different thumbnail views. Like you have a show thumbnail video, show grid video options. It's like a square that should pop up. And if you're on your phone, they're a little bit, they could be harder to manage or harder to uh, move around, but it sounds like that's the thing. Okay, hold on. Have you logged in from your phone before? Yeah. Have you joined Zoom from your phone before? Mm, maybe in your phone. Hmm. Again, I'm not sure if you're on your phone or on your computer. Sounds like you're on your phone, but um, do you have the Zoom app on your phone? Hmm, you do. Yeah, then it could be something, a set password. Not sure. Mm, okay. Yeah, I'm sorry. Yeah, I'm sorry about that. It's really hard to help with, in everyone's different devices, and we typically only know our own, but okay. Okay, so what was I saying? Okay. So in that profitability ratios uh, page, there were a few others that we didn't talk about, and I'm not going to test you on them, but I thought it's it's probably something that people might be interested in. So let me talk about each of those ones that are listed there. Okay, so a basic EPS, let's see if they have it here. EPS. They do. Okay. Okay. To comment. Yeah, this is like so you all know that we had the file I gave you for ratio explanations, and then we had the obviously the OpenStax video that we had those ratios. I talked about it through the use of the Lowe's financial worksheet to look at all of them. And then we have this one here. And it's good. I like it in the sense that it's a good breakdown of everything on one page, and then also, gives you like, information about it. But some of them are, I feel like, a little bit hard to understand. And the PE ratio is, I'm sorry, the EPS um is I don't really like that. I don't really like that formula. So what we have over here, what does it say? Net income minus preferred dividends. That's even weighted of common shares outstanding. I mean, I'll give you like a maybe like an easier way, more fundamental, I guess you could say. Let me go to Yahoo Finance again. I'm not going to spend too much time on this, but let's go to a company like let's see how NVIDIA is doing. NVIDIA. Okay, let's see. Let's go to, they should have a PE rate. So here's the PE ratio right here, 43. I keep saying PE, EPS, earnings per share. Okay, the EPS, the earnings per share tells us how, like, the EPS is like if you which is stands for the earnings per share. It's how much profit the company makes for each per share for each one of its shares. So I guess I'll just put a little note up. Again, that you're not tested on this. I don't want to spend a ton of time, but it was in the reading, and I do know that people, are somewhat probably interested when it comes to companies and how to determine whether, a stock price is good or not, which leads us into our next topic. So this is entirely connected to what we will discuss in a minute over on business math, okay? Okay, so EPS is known as earnings per share. And you can think of it like, how much profit the company makes per share or for each for each share of stock. Okay. And a simplified formula, a really simplified formula would just be EPS is equal to like the company's net profits. Now, you saw in the reading and also in the financial statement analysis page on principles of accounting, it's more complicated than that. But in terms of like a basic way to understand it, because that's what I really would like for like the last 2 weeks, really, like ratio analysis, and then earn these little tools here as well as what we're going to do later. They're just like some basics that like everyone should be able to understand if you're working in any type of financial like field. Okay, so EPS is your earnings per share. It's the amount of profit that the company makes for every share of stock. So because, per share or like for every. Remember, we kept defining it that way when we were doing the meanings of the ratios. When you say for every, for each, for $1, for every $1, that's your denominator. And so you can see here in my simplified definition, for each share of stock, that means that the denominator has to be shares. Okay, so we can say number of shares. Okay, and that's what the EPS is. So like if you look at profit and the profit was like if you think of profits like a pie, like a whole pie, and the whole pie is the profit, then the EPS tells you how big each slice of share is. Does that make sense? Maybe I could draw it, right? So like here's the profits. Okay. All of it is profit. Say a company makes, I don't know, $100,000 in profit. Let's just keep it like real small, right? Profit is like 100,000. Let's pretend, okay? That's the whole pie. So if there were 4 shareholders, okay, then the EPS, right, would be 25%. Okay, the earnings per share, right? 25,000 per person, right? So that's what it means. The EPS is like the size of the slice of profits per person, per share. Okay? So yeah, $100,000 for shares. Each share earns 25,000, right? You can look at it that way too. Each share earns 25,000. If there was 100,000 in profit and 4 shares or 4, owners, okay, each share earns 25,000. Okay? So that's EPS. And what does it say about it? That's what EPS is. And let's go back over here. What does this say about it? Earnings per share is a profitability ratio used to gauge a corporation's performance. It indicates how much the company has earned for each share of stock it has outstanding. So every stock held by the investor. The higher the EPS, the better the company is performing, and the more attractive it appears as an investment. So the earnings per share is $4.04 per share of NVIDIA stock, but NVIDIA is there's a lot of shares, so that's kind of the thing when you have so many shares. I mean, it's good because you have investment, but then the slice of the pie becomes smaller, right? So, there's that. Mm, you might also look at it like against its competitor. So this is an NVIDIA, which is like it's a technology, right? So you might want to compare it against a competitor. Okay, so let's just see competitors of NVIDIA.
Yes, AMD and Intel. You don't need to.
Intel. There you go.
Yes,
Oh, there we go. Good, perfect. Good. Thanks, Jim. Yeah, Intel, Google, Microsoft. Okay, so let's go to Intel. And let's see if we can find that one. So Intel is here. Looks like, remember, EPS for NVIDIA is 4.04. And here's Intel. And earnings per share is 0.06. Okay. So remember what I said. This is all one. You can't take one. Oh, look at that PE ratio. Oh, this is terrible. Don't buy Intel. No, that is a crazy PE ratio. That is crazy.
Yes,
Let's look at
because
the,
they spend lots of money on the development of research,
okay.
so not much profit at this time.
That's a good point. I wasn't aware of that. Sounds like you know a little something. So, okay, yeah, because right now that's great. Maybe over time it'll level out. Very good. Interesting. We haven't talked about that PE ratio yet, but I can see like, holy cow, that's crazy. But anyhow, PE ratio, P, excuse me, EPS, earnings per share. Okay, so look at the competitors and decide and kind of like, you know, put it together with all the other things we've talked about, which again just the everyday person can do. Obviously this is one day we're looking at here. If I go to like just 1 year, okay, we'll just expand it out, push it out to 1 year, and you can see that it's definitely increased in the price, the stock price over the past year. February looks like about 19 bucks. Here we are in December at 37. So obviously there's okay. Yeah, that makes more sense. You have to look at it big picture too. But just looking at one number, you saw my reaction. I was just like, whoa, that's crazy. And then a very small EPS. So if they are, doing a lot of research and development at this point, then that is information that people are aware of and they have an expectation. What's really interesting, and I always say this when it comes to this section of the course, is that meaning talking about, evaluating a company and seeing whether it's like in a good financial position to be able to determine whether it might be a good stock for you to invest in, which is what we're getting at here. But at the same time, like it's interesting because obviously there's lots of information out there about each company that the everyday person might not be aware of. But what I will say is that it's the stock market, it's a really interesting thing because it all has to do with confidence. And confidence is just this intangible thing that everyone just sort of believes. Like we believe that, maybe Intel is going to come out with something. Maybe we've listened to, their CEOs or like read articles about them, and we understand like, oh, they're going to be coming out with XYZ, next year, in the next 2 years. And so people believe in it. And so they're willing to, buy Intel stock, right? Because one measure or the EPS for NVIDIA being better, you get a better slice of the pie, right, from NVIDIA than you do with Intel. But it doesn't necessarily just mean that one thing is going to tell you whether it's good or bad. It's a lot of different pieces together. And what I find really fascinating about the stock market is like, as long as people are confident in the company doing better, then the company does better. But if everyone decides, okay, we're not confident, and they start pulling their money out, why? Because they're not confident, right? There's information out there that's leading, us to believe that, oh, this isn't going to go very well. Let's pull out our money, right? And invest it in safer things, safer options. So
So
I've always thought that, go ahead.
question, like a 0.006 is still higher than the interest rate, right? Like interest rate is 4 point something, but
Sure.
the dividends is a 0.006. Is it something like 6%, something like that?
Yeah. Yeah. That's a good point. Yeah. Yeah, so the highest like savings yield you could get nowadays, probably 4.5. So yeah, so it's still better than that for sure. Um, Good point. Really good point. So yeah, that's what EPS means. Let's look at the other one that's in here, PE ratio, so market price per share. Um, that's good. That's a good one. Let's look at what this one says. I just want to keep them simplified because preferred dividends, weighted out common share, like just I'm trying to give you like a simplified version of what these mean. Um, let's look at the peak market. That's right, actually. Market price per share divided by earnings. Let's see. Market price. Okay, that's a good one too. Um, yeah, Jasmine. It's money. So just like he said, it's like 6 cents. Like this is a decimal. If you look at it like a percentage, it's 6%. So translate that to money, right? And it's like saying, okay, 6 cents per share per dollar. Okay. That's how much they're earning. Okay. hmm That's how much they're earning for every one investment. And then Nvidia, of course, was right? $4, which is pretty good. Um, yeah, keep the questions coming. I'm trying to keep it simple though. I'm not a full-on financial analyst. Okay. PE ratio. PE ratio, market price per share divided by the earnings per share. Okay. What does it mean? Let's go to this one. What does it mean? Let's see. What does it say over here? No, I want to say what I think it means. Okay, because when I read it, it messes me up. So let me just, because I know what it is, I just have to put it into the right words. Okay, earnings per share is, let's pull up my thought box over here, my thinking box. PE ratio. It's price to earnings. It's like I have to think it out loud. So it's price to earnings. So it means price to earnings, where it's price per share. Price per share. Okay. So this is how much people, yeah, how much people are like how much people are willing to pay for a dollar of the company's earnings. So the people are willing to pay how much they're willing to pay. So this PE ratio is saying they're willing to pay. I know it sounds crazy because this one is such a very high PE ratio, but $620, and that doesn't seem realistic, but okay, it is what it is. Like you said, they're doing a lot of research and development right now. Okay, fine, but this is like this is so if it's high, it means that people are paying more because they believe that there are future potential growths. That's why I'm starting at, or before this, I was saying that it's very fascinating because it's about what people believe. So a high PE ratio is a perfect example of that because it means that they are paying more for a share, okay, uh, because they believe that there's future growth in that. If it's low, it means that it's okay to be low. Well, how low? Um, the stock might, if the PE is low, it might mean that the stock is cheaper, just compared to how much it earns. So like, let me think of an example that's okay, like if a share costs $50 and the EPS is $5. Okay. Their earnings per share. So they're willing to pay $50 for every $5 of the company's earnings. I'll go back to the text right now. I'm kind of sounding choppy. I realize that, but It's like I got to get it in my head before. Um, and then when I read it, it'll make more sense to me. Or sometimes that happens. If a share cost, so the PE ratio is the price per share, so 50 divided by the earnings per share of 5. $10 for every dollar of earnings. Hmm. Mm. Oh, okay. So like thinking of an example, it's coming to me. It's like a price tag versus what you're going to earn from that asset, like a house. So the earnings per share is like comparing the price tag of the house compared to the rent that you'll earn from renting it out. That's what an EPS is like. It's it's the price tag compared to the earnings that it's going to get you. There we go. Okay, cool. It's a price tag of something. I just want to put it into regular terms, if that makes sense. Because when I look at that, it's hard, right? Like for the average person to just go like, what? I just like the ratios were for a lot of you these past few days, right? It's the same thing, another ratio here. So you want to try to figure out what it tells you, in a kind of a real world example. Now with the EPS, it's kind of easy because you can look at it like a pie, where the pie is the profit for the EPS, right? And then a slice of the pie is like that's the earning per dollar of profit. Okay, so that was kind of easy, a pie. So that's what I'm trying to think of for this one. A PE ratio is like a price tag for something as it relates to the profit that it's going to, or that the earnings that it's going to yield in the future. So like think of buying a house, you're willing to pay so much for a house for the rent that you'll receive from renting it out. Okay. Okay. So that's my example. I can't really draw it. But let's go to the text and see what it says there. Okay. It says two other ratios investors use to gauge how attractive a company is as an investment, is the price earnings ratio. And the PE ratio compares the market price of the stock, which is what an investor would pay for each share, to the EPS, to the earnings per share. Okay. Okay. So a high EPS in comparison to the market price per share this is this could indicate a bargain price for an investor. Again, it doesn't give you that much. It doesn't give you that much like of an example. It's just a really short little thing there. Let's go over here. I say I don't want to take too much time and then I'm just curious. That's all. Like I don't do this all the time. So I'm not like fully, versed on it, but once I get in my head, and that's what I like to share with you, like once I get in my head what like an example, I feel like it sticks a little bit more each time. And again, I don't test on it. It's just always appears in the readings or appendices or anything. And then I like to just, work through it a little bit. Let's see if there's anything else in here that talks about PE ratio. Let's see. Because what I do know is, I told you I used to take these classes when I was like in my 20s, like the Motley Fool is like an economics thing. And at that time, I remember them talking about nothing in here, huh? No, nothing on that one. them talking about how I think it was who Warren Buffett, billionaire Warren Buffett. Um, he said that the appropriate PE ratio for a business that he invests in, like his advice for PE ratios. No, we don't have anything in PE ratio here. Times debt to equity, solvency, quick ratio. No, no PE ratio on this one. Okay, that's fine. He said that uh, a company's PE ratio should be about 20. And if it's over 20, it's overpriced. So that's why and I've carried that in my mind for so long. That was, almost well, probably 20 years ago when I was trying to get into investing and then I just didn't pursue it, but heavily anyway. But I remember that. I'm like, oh, Warren Buffett, like he's a billionaire, he must know. And his advice was that the PE ratio should not be not too far away from 20. So seeing this one just really stood out to me. But again, it's people are it's the price that the price tag that investors are willing to pay for just $1 of the company's earnings. So right now, it they're really confident. Are they overconfident? Who knows, right? Maybe there's some other information coming out from Intel that tells them, oh no, it's what they're going to come out with is big, right? Let's check Tesla. Let's look at a year. PE ratio 325. See, so Warren Buffett would say all of these greatly overpriced. But again, it's the confidence. It's the confidence. Let's check Amazon. Let's go 1 year. Come on. Ooh, that's interesting. February, that's the whole year. Huh, okay. April. See, as you move it across, you can see. 167. Wonder what happened there that it was so low. PE ratio, there we go. 31.38. Okay. So I guess what I would say, because I'm telling you, this has to do with multiple things like information that people know about these companies, right? What I'm trying to give you with all this are some basic things to look at. Okay.
How about Walmart compared to Amazon? I just wonder.
Oh, sure, sure. Let's look at that. So we got 31, 38, and then 7. That's pretty good. This is good. Buy some Amazon, buy an EFT. Let's see. Walmart.
You see some
40,
off ramp for the
40.
eastbound
And the current price is 115. They're both good.
slowing.
They're both
Ah,
good. Just
surprise.
yeah, yeah. And so, so the simple things to look at, because I personally would have looked at Intel and been like, whoa, what's going on with that? It probably would have made me like look deeper into why in the world that would be. Let's look at Meta. Ooh, look at that. Okay, PE ratio. That's okay. This is good too. These are good. They're high price, but you have to understand that the platforms where you can invest, Robinhood, SoFi, like there's tons of platforms you can buy stocks on for your own trading. You're not buying a full, like you're not buying a stock. You're buying like a piece of stock. And that's what's really great about the platforms that they have out right now is that you can just purchase like a portion of it and still, have gains. And so what's interesting is that there's all this talk about the economy and everything. Like what we as the everyday person look at are how much, we pay the highest price in the country for gas as Californians, right? We pay really high, sales tax, city tax, if you're in a certain city. Like I'm from Pico Rivera. It's off the 605 freeway in between the, like this, it's over by towards LA, but not quite. So that city tax is like one of the highest in the state. Their local tax is on sales is like 13%. It's crazy. So we pay super high taxes. So for us as individuals, we're always looking at, quote, the economy. We're always looking at the economy in terms of what we can afford, like what we can afford. Our groceries are higher, our gas is higher, and then we blame all the politicians. Why aren't they doing anything? And it's not, I just want to let everyone know that's not exactly the economy. When we say the economy, um, it's important to understand that. Like I have to shop at Aldi because Stater Brothers and Alberts, those are so expensive for my grocery shop shopping. So it's real to my life, the economy of my household, but it's not necessarily an indication of the overall economy. Okay. And so when we search these big corporations, like we need these corporations to be doing well, right? Why? Because if you have a job and you have a 401k, your dollars are in this market, right? If you have a retirement account, okay, your dollars are in the market. They might be in safer places, but they're in the market. So we want the market to be doing well. So the average person might say, oh, well, only billionaires and millionaires, benefit from this. Well, yes, they're the ones benefiting millions and millions of dollars. True. I'm not saying that's not true. But if any one of us has any type of retirement account, we need it to do well, right? We need people to be confident in the market. So these numbers, just looking at some of the major ones just now, it's like, okay, like it's simply, and looking at their past year, right? Because we typically look at things year over year. We want to, know that generally these businesses are doing well. Now we're looking in tech and like farm what is it called? Not pharmaceutical. I guess pharmaceutical, right? Let's go to Eli Lilly right here. Let's look at a year. Okay. PE ratio, earnings per share. Look at that. Look at the stock price. Holy cow. That's why they make billions, right? Because they have multiple shares and maybe they bought them. We should have bought some at 625 and we in August and we would be $400 in profit right now for one share, right? So again, the average person is not just like buying one share of $1,045 stock in Eli Lilly, right? But we can go and we can see that these little ratios here, like not terrible, like PE ratio. This is the price tag that we're willing to pay, right, for every dollar that the company earns, because we're confident that it's going to do even better. Does that make sense? It's a weird thing. I find it fascinating. I wish I wish I had more time to get into it because I do understand the fundamentals, but that's just what I want to share like with you guys. Like if I can share just a couple of little things, earnings per share $20, like that's good, like that's how much that's your out of the profits. Let's say the profits were, you know, $100, your slice, your earnings per that share is $20 per those profits. For every $100 of profits, you would have 20 if you had one share of the stock of Eli Lilly stock. In basic terms. It gets a little convoluted when you look at, especially when you see the other sort of definitions of these things. Okay. But I just want to keep it real simple for you. Like I said, share what Warren Buffett said, 20 on the PE ratio, otherwise it's overpriced. I from every year that I teach this and I go over this, it's pretty clear to me that, 20 is really rare to find, but I suppose if you find it and everything else looks good too for that company, it's probably a good stock. But, you know, lots of people say that the stock market is just overinflated, but that's the thing about it. And that's what's kind of risky about it, right? Like if everyone just decides like, oh, we don't believe in this anymore, it all falls apart. We're all bankrupt, in our retirement accounts. So we want these big companies to do well. And there's a lot of, you know, I'm sure valid points of criticism for these companies, like, oh, they don't pay taxes and they're making all the money and da da da. Yes, that's true. And I'm not going to refute that. But if we are people who have stake in the market, we want them to do well. We don't want them, I mean, unless, what do you think is going to, I don't understand that argument. So some people feel very strongly about it. If you're one of them, I'm happy to have a conversation about it. But like, if they just dismantle and disappear, like, what they're not going to distribute their money to every American, you know what I mean? Like that's not going to happen. Even if the like Jeff Bezos isn't going to like dismantle Amazon or Elon Musk dismantle all his companies per the pressure of the general American public because they're too rich and start handing out checks to people. Like that's never going to happen, right? Like it's just never, that's regardless of people who really feel strongly that they shouldn't be, people shouldn't be that rich, It's like there's really no way to dismantle it without the impact to the market. That's all I'm trying to say. And that's not political. That's like a fact. Like it's I remember I studied economics, so like even though I'm not a financial analysis expert in stocks, I know how the economy works. And I promise you, if those people dismantled their companies, that wouldn't be good for the everyday American who is invested their pensions, their retirement accounts in the stock market. That's all I can say. So, and then some people will say, well, not everybody has an investment account like at all. And that's a fair point too. It's like if you don't have any investment, then what do we care? If you have no retirement account, why should we even care? And I think that that's a fair point too. I'm sure there's many Americans who might feel that way. So that's kind of a different discussion or a fair argument, I suppose. But at any rate, if you are someone who wants to have a job that has good benefits, wherein you have any type of pension or retirement account, you should want the market to do well. You should want these companies, these big ones, to do well because it shows that the economy as a whole is still strong, right? When people start not being confident, we're going to see everything drop, including the value of our retirement accounts. Okay. I mean, we work our whole lives, right? Like that's kind of the whole point. Like you can say, oh, let's go live in Italy where like they don't have a care in the world. They take they close the shops at 11 to 2 for their siesta and then go live in Italy. I mean, but things cost less or whatever you want to say. Like, you know, that's fine. America is notoriously like this work hard, play hard place, And so if we're gonna be involved in the system, then we probably are working hard and we want to enjoy that at some point, which requires us to either save just in your savings account, I guess, but you can also, invest your money because we have confidence that it's a strong economy. Now, is there always a risk? Yes, always. Always, right? There's always a risk. So that's the risk we're willing to take. But we want everyone else to risk it too so that there's confidence. And that's kind of how it all works, okay? All right, let's go to the last one and then I'll move on. The dividend yield. Ooh, okay, dividend yield. Okay, this is cash dividends. So we know what that means. That means dividends we understand are the portions of profits that get distributed to shareholders, right? Those are payouts. Not every company pays them, okay? But some companies do, and we might look at the dividend yield as like you know, so a measure of like whether we think purchasing that stock is the right move for us. So it's basically a percentage of your investment that you get back each year in a cash payout. Okay. So see, cash dividends per share. So the dividends per share divided by the share price. That's right. That's right. It says the dividend, how much investor receives in dividends in comparison to the market price. A high dividend yield indicates that investors receive a healthy dividend for their investment, which can make the company's stock appear attractive. Okay, let's see. And let me move this out of the way. Okay, let's see. Dividends are like cash back. I think that's what I would say for the analogy. You know, my first analogy was a pie. My second analogy was a home, like the cost you're willing to pay for a home versus compare as it's compared to the rent that you'll receive from it, you know, your earnings um from that purchase. That was my second analogy. And I think this one is just a real simple cash back. Dividends are cash back. Like when you uh, you know, maybe you have like a Chase account or a Wells Fargo account and you get cash back on your purchases. That's what a dividend is, really. It's just cash back on what you've paid. Just like your cash back, you go to the grocery store, you maybe you're getting cash back on groceries or something or on certain types of purchases. You pay a dollar amount and you get a certain percentage of cash back. It's exactly the same. Okay. This one says forward dividend and yield and then ex dividend. I think that this is like the expected one and this was prior. So maybe they change it. Maybe it changes for them. I'm not sure. I know what it means, but like I just said, it's cashback, but I don't quite understand forward and X, to be honest with you. I'd have to look at that further, but I think it just means right now, this is what it is. But this is a future date. Maybe it'll change. Maybe it's going to change in February of 2026. I'd have to look more into that. But as far as it, let me look at another one. Let's do a different company. Let's get out of tech and pharmaceutical and just do like a oh like a Home Depot. Let's see. PE ratio, EP earnings per share. Look at the year. I always look at Home Depot just because it's one of the first ones I ever looked at. Like if I go to 5 year, 2021, yeah. Back then, open 258, it's at 350 in 5 years. It's a very like stable, you know, the market is volatile. Volatile is this is the definition of volatile. Every time you see every company and it's all up and down, that's what we mean by volatile. We rarely see like a steady growth. You know, like steady would be if these things went like started here and then they started going up, right? And like, oh, okay, like that. And it starts like that. That's sort of steady, you know? Not high highs and low lows like we have, you know, from here to here, right? That sort of difference in gap is that's volatility. And our market's volatile and it has been, and that's what's I think that's what scares people is the volatility of the market. You can just have your evening news on every day, and it's like, oh, stock market went down 1,000 points. It's the largest decrease in the last whatever years, percentage wise, and it's just all this like, oh, is it bad? And then the next day it's like, oh, highest breaking earnings day. It's like you can't look at it as a day-to-day thing, especially if you do have, retirement accounts, because you're investing in the long run. Okay. And so like this that I've been, using as an example for a long time. That's why I have the Lowe's, because I look up Lowe's versus Home Depot, right? So this is a 353, 24, 14 dividends, bigger than they were in the last company we had up here. So that sounds good. This seems good. And there's like it's not a super high gain from 5 years ago, but I would say it's pretty steady, even though there's a lot of volatility over the last 5 years. Okay, it's still, if I look at when I was taking a look at it, definitely 271. Okay, like 5 years to earn that much, it's pretty fair, like it's pretty reasonable. Let's look at Lowe's. I don't think Lowe's does as well. Let me look at the 5 year. Oh, let's see, 160. They're the same. Remember I told you yesterday, when you start to consider if you're interested in investing in things, one of the tips, is to like think of what you like to do. Are you a a DIY person? You like to do home projects and stuff like that. You go to Lowe's, or maybe you're a person like that and you prefer Lowe's over Home Depot, or you prefer Home Depot over Lowe's. And then you can look to this, and PE ratio is fair, EPS is fair. There's steady growth over the 5 year period. You like it, like all those things matter. So you're willing to, and the reason why you want to start with things that you like or companies you like is because you're more willing to weather the storm when it has really, look at this, 2021 on this date, it was 200 and it closed at 261.38. It's still not 261, right? Look over in this state here, just about 6 months later, whoever purchased up here at 261, they just lost $90 per share right here. So when you are invested in a company, you're loyal to it, you're more willing to hold your dollars in there, and over time, you expect it to either remain steady or give you some growth. Okay. So that's kind of the idea. And again, these numbers, dividend, I mean, all the ones we've looked at are doing pretty good. I want to see if there's any other, like, let's look at Nike. And I promise I'm done. We'll move on. It's been an hour. Okay. Let's look at a year, 5 year. Is this the 5 year? Oh, wait. Ooh. Is this the 5 year? Oh, it is. Ooh. Hmm. Interesting. Ooh, interesting. PE ratio 34. Okay, it's okay. EPS, uh, your slice of the pie is giving you really a little bit. Very low dividends. I don't know. The 5 year doesn't look great. I don't know. I wouldn't, just looking at that, I would be like, they're not something I'd want to invest in right now. Okay. Just on that, just look at a 5 year for any company, right? We've been recovering since COVID when things were down. Everybody should, honestly, in the 5 year, like companies, the big companies should be doing better. They should be, you know, because 5 years for us is 2020, which is COVID, and everybody was down. So to see a 5 year that looks like this is really like not good. Imagine if you bought the stock at once, what is this, 170, 177? Holy cow. What's going on with Nike? Let's look at Adidas. I get interested when I start looking at it. Ooh, I don't like this because I don't know which one it is. I don't know which one I don't know. Some of them go on different they're tracked on different things. So I don't know that this is the right one that I'm pulling up, but I'd have to look at. So why does it say that? Let's see, hold on. Yeah, see how this says NASDAQ real-time price USD? This one isn't. It's Europe. Let's see. I don't know which one I should look at. Okay, this one does say USD, OTC markets. Um, well, regardless, I think it's doing better than Nike. I like looking at them because uh, Adidas is kind of like they have a smaller share of the market. They're not as dominant as Nike, but they do really well. I've done the financial analysis on their financials and compared them before in class, and it's really interesting because even though they're big, of course. They're big, but they're smaller compared to Nike, right? And so it's interesting because all of their ratios they're very like efficient. That's what I've noticed. So just based on my history of always looking up Adidas, and I probably do this every time where I look up all the different Adidas things that pop up, Adidas is always performing better than Nike when you do a full ratio analysis, which I think is really, really interesting. I can do this all day. I'm sorry if I'm boring you, but I just want to give you, well, first of all, I wanted to cover those ratios because they're on the reading and just let you know that you're not tested on them, but people are interested. It does segue us into our next topic in business math, which is called the time value of money, and we'll get there. Um, and I just think it's, useful information for the everyday person to look at EPS, earnings per share. Okay, how much is the slice of the pie of the profits um, of that business? Out of the profits, the slice of pie is the earnings per share. Like how big is that pie? Okay, price earnings ratio. It's like a price tag that people are willing to pay, okay, for every dollar that the company earns. Okay. Like it's like a price tag. How much are you willing to pay for it? And Warren Buffett says about 20, but I think as high as like 50, 60 for big companies. I can see them 80 or 90. But once you really start getting over that, you would have to know a little bit about the company, just like Jin was saying about um, Intel. Like I wouldn't know that, but I'm sure that's true. Right. If it's really, really high, then maybe there's some more research to be done in the PE ratio. People are really excited about the investment. I know which one we missed. We didn't look up Apple. I like to look up all the big ones. Don't worry about all that. Look at the 5 year. There you go. There we go. That's probably the best 5 year we've seen. Which makes sense because people love, Apple, right? That's the best one we've seen of everything. There's less volatility in this 5 year chart than any other chart. PE ratio 37, that's fine. EPS 7, not terrible. I mean, it's fine. We've seen bigger ones, but it's steady and it's steady growth over time. Okay. I don't know if they pay dividends, to be honest. That's a simple Google search, though. You can look up, like, just Google, does Apple pay? Or Google, because if you're interested in receiving dividends, right, cash back dividends, just Google, like, top um, stocks that pay dividends, that pay high dividends. Okay. Verizon, Chevron, Merck, Coca-Cola. Okay? Or look at any of those articles that were below. High yield saved best dividend stocks. Okay, so again, so dividends, it's like your cash back. And just remember that, wait, what class is this? Oh, oops, sorry. Just remember that uh, um, depending on how much you get back in your dividends, you might have to declare it in your income taxes. So they'll send you a 1099. I forget what the lettering is on, or a 1099 INT, I think. If you're in the payroll class, we talked about how that 1096 form, the company, I know some of you are in payroll or have taken payroll. We talk about the 1096 and how they check mark all those boxes. There should be one for 1099 INT for interest. So again, just know that Target, look at people love Target. The Target. I'm sorry, you got to tell me to stop because I can just keep going. Um, I promise we're finished. Oh, Target, what's going on? Okay, well, yeah, now that I think about it, they've had some bad press. They've had some bad press for sure. 5-year PE ratio. You know what? You know what? I'm the type of person where like I kind of like love Target and the PE ratio's low. This could be a good buy. It could be a good buy if they can weather their storms. This might be a good buy, honestly. Dividends, okay. EPS, okay. And why do I care? Because because it's low, right? So it's low. So it's going through a period of bad press. They've had a lot of bad press, and people, the market, we are the market, right? We're the consumer. We react to what we see, right? People are like, oh, don't shop at Target. They're under this, they're promoting this, or they're not promoting that. And they're trying to weather that storm. So they're down right now. Um, and that's why I go back to what I said before. What do you like? Start with where do you shop? What are you loyal to? I love Target. My kids love Target. My kids grew up on Target. I try to take, let's go to Walmart, and they're like, no, let's go to Target. I'm like, Walmart's fun too. Trying to get, they're like, no, we're Target people. I go to Walmart behind their back sometimes, but we're Target people. And because I'm loyal to Target and because I know a little bit, and I actually do know that they're weathering this storm in the press and sort of cultural uh, societal things that are happening in the culture, I would be loyal enough to say I probably would buy Target right now. Yeah. Okay. Okay. Yeah. Costco. Oh, what site can you buy stocks? Good question. So I was mentioning like Robinhood. So just Google it. There's Robinhood. There's SoFi. There's Turbo. What's the um not Turbo. Gosh, it's like a let's see. Yeah. T t Not Turbo. Oh, E-Trade. Okay, this is a good one. Okay, so I know SoFi, pretty popular. E-Trade is popular. I haven't heard of Public, but okay. Those are for high yield. Robinhood. I'll tell you the ones that I've used before. I've used SoFi, I've used Robinhood, and I use gosh, it starts with a T. Turbo? Can't think of it right now. Hmm. But I just want to say that I've used these ones, and I know E-Trade is really easy, and it's from Morgan Stanley, which is a huge brokerage firm. So it's very, very trustworthy, E-Trade. They all have like, fees. They might even have uh maximums, so if you're, have tons of money, you can only do so much per day. It's kind of like for beginners. SoFi really popular because the zero account minimums. You want to be able to buy EFTs, okay, which are really popular right now. Um, An EFT is a type of investment fund that has like it's like having an EFT is really it's like having like a I don't want to say like a ball of everything. That's what an EFT is. It's like a not a ball, like a basket of different things. Um, Stocks, bonds, like all the different types of investments, and they're typically solid choices if you look for the right ones. But EFTs are really popular because you get a like a basket of all the good stuff. And so of course you're buying little pieces of different stocks and bonds and whatnot. So yeah, check them out. They're apps. The apps are really easy, really, really easy. Robinhood, SoFi, and E-Trade. I would say those ones for sure. I wish I could figure out which one I'm thinking of as far as like um gosh, I can't remember it. It starts with the T. Can't remember. But anyway, yeah, I recommend a Robinhood, SoFi, and E-Trade. Okay. They're very easy apps to set up just from your phone. And then just because I'm crazy, um, let's look at Costco. Oh, where did we go? What happened? Costco? Costco. Oh, it's one of those things too. Okay, this is NASDAQ. Yeah, you want to see NASDAQ or the NASDAQ or the NYSE, New York Stock Exchange. Make sure when you look at it, you're looking at the US markets. Like you want to see the US ones they're trading on. The other ones I'm just not familiar with, so I can't speak to that, okay? There are other, um, the European platforms, the Asian markets and all that, but I'm not familiar with what they look like or anything. So I would just say try to choose the ones that say when they come up, choose NASDAQ or New York Stock Exchange. So it'll be NYSE and then make sure it says USD. All right, PE ratio 45, EPS 18. Okay, this is just a bad day. I'm sure their 5-year is good. Look at that. That's even better than Apple. There you go. You're right, Katerina. Wholesome choice. No controversy with Costco. I'm still, I don't have 855 to buy a Costco. I could barely afford a Costco membership. I live in a small place, so I can't really be a Costco person because everything's big and I don't have the space for it. I'd have my garage full and then I have to park my car outside or something. So, but Costco looks good. It's very steady, very solid. Dividends, EPS, looks good. PE ratio looks good. 5-year looks great. Go for Costco. Buy a portion of it on SoFi. Okay, well, I know I spent an hour of your time on that. I hope you found something. That means how much it costs. That's how much it costs today. If you want to purchase one share today, it's going to cost you $855.
How about Nike?
We searched Nike. It's doing terrible right now.
Okay.
Yeah. Yeah. Yeah, we pulled it up. It's doing awful. Let's look at the 5-year.
Okay.
Yeah. Yeah, Adidas is doing better than Nike.
Yes, but compared to in April, it's still much higher than the April stock price.
Yeah. Yeah, but even just a 5-year, like that, just looking at that, it's like I said, most companies should be doing better because for our period of time right now, like COVID was 5 years ago. So we know COVID was lower, like everything was lower. So we should see all these big companies doing better. Like we really should, the fact that this is such a decline, is concerning. But again, so is Target, right? So like maybe you have someone out there who is a big Nike fan and they're like, "Ooh, I'm gonna get in on Nike right now because it's only 66 bucks." And I believe in Nike, they're going to turn it around. And so you might, if loyal people decide like, let me get in on that now, then they might see larger gains. So it's kind of interesting. Like me, I'm like, oh, this is good. I can do Target because I'm loyal to Target.
But
So
we need to also consider the economy situation, like the income for each person, something like that, right? Like a
yeah,
job.
of course. Of course. That's why I was saying earlier that
Yeah.
there's the larger economy and then there's our personal household economy, right?
Right.
We all represent an economy in our
Yes.
individual spending, right? And in our
Yes.
individual budgets. But
Yes.
so what I was saying earlier is that we if we are people who want to invest, who want to have a retirement account, who want to, who might find jobs that have pensions, we want the big companies to do well. Like we want them to. So even though we have limits in our personal spending, we still want the bigger companies to do well because we're invested through our retirement accounts. So, I just wanted to make sure everybody understood that, you know, even though we have our personal spending habits that have limits, it and everything feels expensive, it doesn't necessarily mean that the whole economy is doing badly. Okay. But when we look at companies like you're saying, Nike, um, people just can't afford, those things anymore, right? People don't want to pay, you know, $150 for a sweatshirt. So
Right.
that's going to have an impact. Yeah, because our personal, you know, I guess companies that rely on the everyday consumer might be feeling um, the impact of the individual households. Yeah, for sure. And so Target, we looked up Walmart, right? And Walmart's doing better than Target, right? And again, that has to do with certain, like I said, with Target going through some um, issues with their branding, marketing, whatever you want to call it, but a competitor of Target would be Walmart, and Walmart's doing fine. So Target might experiencing the backlash of some societal issues or cultural issues in the society, but also people have alternatives. There's alternatives, right? We can go to Walmart. Like I told you, I go to Aldi for my groceries because it's way less expensive. And they've even gone up in their prices, but it's still less expensive than Albertsons. It's less expensive than going to Vaughn's. So I like Aldi. I go to Aldi because my personal economy of my household requires that. So, as far as investing is concerned, yes, you do need to take into account all the factors and probably Target's more expensive, and so maybe people have decide that their alternative is to go to Walmart. So there you go. Okay. All right. Ben, did you come late? I'm not sure if you came in late, Benjamin, because we've been talking about this for an hour. We want to talk, we were talking about all the three ratio. Oh, I'm sorry. Well, getting back to let's wrap it up then, right? So you're asking how many factors. Well, the ratios, of course, that we talked about in the on yesterday. So we had about 6 there. And then I wanted to cover these ones because these ones are what you would track, in the stock, on the stock market. And then just overall their 5 year. I think we're in a good position to take a look at the 5 years because of COVID was 5 years ago. All the numbers should have been down here because that's just what it was. And we can see like people recovering or businesses recovering. So I think it's not about like how many factors. What I've wanted to do, over this time of talking about all this analysis is to give you just several tools. It's not all of them. It's not every single tool available. We didn't talk about every single thing on this list either, right? But we can use certain ones that I've tried to share with you to make a decision based on whether you would like to buy a stock or not, and like whether you feel like the company is in a good position to be profitable in the future. Okay, so I hope I've given you some tools to be able to do that. And another one is coming up. Okay, so another one, we're going to switch gears now. And another one is going to be, it's very basic. Okay, I'm going to tell you this right now. If we go over to business math, okay, this is because I told you that whole thing, you're not tested on that, but it's important, it's useful, and I hope you found some value in that conversation for the last hour. And it's a segue to our business math lesson on time value of money. Okay, so we're going to get into time value of money. And before, oh, I don't want to do that. Okay, that's fine. You can look at that, but that's not the way I want to teach it. Let's take a look at this one. Video. Huh. Oh, interesting. Okay. Where's my worksheet? I need my worksheet. Oh, I don't have it in here. Let me go back to accounting. Maybe it's over there. So this concept of time value of money is a way for us to price. So we've talked about all those things, all the ratios, all the analysis, EPS, earnings per share, dividend yield, right? I've talked about all those things. There's one more, and it's going to be, where is it? Hold on. Oh, where is this thing? Gotta share it with you, I think. Time value of money, which is, oh boy. Uh-oh. Okay, I gotta find it. It's almost break time, so that'll be fine. I'll just get it from my other computer. Okay, so we're going to be talking about time value of money, the lesson you saw in business math, and it is one super simple, not sophisticated, but very basic way to price whether a stock is a good price or not. So we looked at all of these things. We introduced, dividends, cash back, EPS is a price tag versus how much you're going to get out of it. The PE ratio is your slice of profits, like how big is your slice of the profits, in addition to all the ratios you've already learned, which you could apply to any of these businesses. The last thing we'll do on this is to price, like, is this a good stock price or not? Is the price right? That's what we're going to take a look at. And it has to do with time value of money. Is the price right? Okay. So I guess we'll go to break in a minute, but let me see what I have here. Okay, time value of money is the idea that a sum of money today is worth more than the same amount in the future. Yeah, I need my sheet. This is fine. It's all good, but I like working from this one worksheet that I have that I will have to get on the break and share it with you after. But that's what we're getting into. So like our dollars are sort of like more valuable now than the same dollar 5 years from now. Does that make sense? I'll say that again. The idea is that the value of our dollar right now today is more than the same dollar in 5 years. That's what we mean by time value of money. So when we get back from break, I have this worksheet I'll share with you, and kind of the first thing on the worksheet says to consider, like, let me just say this, like, if you won the lottery, right? If you won the lottery, you have two options. You can either take the lump sum now, or they can pay you monthly for the next 20 years. Okay. So what would you rather do? So think about that. Okay, I'll leave you with that before break time. Would you take the lump sum now, or would you take payments over 20 years? That's the question. That's time value of money. And that's what we'll talk about once I grab my worksheet, and we'll get back to it after the break. Okay. So I'll see you back at 11:40. I'll see you back at 11:40. And so I sent the file that I needed through my email, and I'm waiting for it to come into my email so I can put it here on this device. And I'm like waiting and waiting. I just had to put it on a flash drive and move it over. So oh no, my old computer I need to take it in for like a repair, because it doesn't matter if I restart it, it'll be okay for like an hour, and then it starts going nuts. So I've done all the things, cleared all the things, all the temporary files. I've done it all, but it's just old. It's like 8 years old. So it's a great computer, but it needs something. So I got to take it in over the break. But anyway, I got a new laptop, and it's been good, but it's just functions differently than my old one. So that's kind of hard to get used to. Anyway, let me go to the module here, and I'm just gonna add it. Yeah, 8. Not 18, 8. Oh yeah, 8, yeah. Okay, let me add it over here. That's the last. Let me add the file. I'm just so crazy because I don't have it on here. Let's see. Well, what did I do with it? This. Yeah. Yeah. Wish I was a little bit better at that. Okay, so let's go to file. That one, this one, to this one, and this one. There we go. Okay, that's the one. Alrighty. This back over. Like the entire time that I was swear I was I was doing that. I was took me the entire time to get that file over, and it ended up just being having to get my flash drive. Okay, here we go. Let's put this up here. You can refresh. Go ahead and refresh your tab. In week 9, you'll find time value of money, stock price valuation. And I like working from this, just easier to teach than the lesson that was kind of just laid out really generically. Let's see. Let's go ahead and open it in Word. Okay, so I left you with the question, and I wonder if you thought about it. Okay, and okay. And so if you won the lottery and they give you the option of a lump sum, $20 million right now, okay, minus taxes, versus payments over 20 years, monthly payments, um which would you prefer? Just curious, what would you prefer? Excuse me. Oh, okay, that's fair. That's a good get one time. Jasmine says payments because less taxes they'll take out. Yeah, you could definitely look at it that way. Yeah. So that's the idea of time value of money. And before the break, I had said that, if you think about it, our dollar today, it's worth more today, you know. Yin Shin, you're saying get it right now. Yeah. Our dollars are worth more right now. And we saw that as we look at the stock price, right? Um, you know, if we were looking at the Apple, the Costco, you could have your dollars bought more value at that time because of the return that you get on that purchase of maybe that stock. Okay. So that's the idea of time value of money. It's that your dollar's worth more today. Like it goes like think about it. When I was growing up in the 80s, we didn't have a lot of money at all. And I used to take my mom's like dimes because I wanted to buy candy and she never bought candy. And so I would steal her dimes and her nickels and until I had 50 cents. And when I had 50 cents, I could go buy, I would buy myself like a Reese's Pieces or something. And, that's a long time ago, 50 cents, whatever. Um, Also, like a bag of chips was like 50 cents for a small bag of chips, like the snack bag. Um, Nowadays, you go in the grocery store in the checkout and you look at a Reese's Pieces and maybe it's on sale. If it's on sale, it's $1, right? But typically it's like 169, 159, 169, right? So that just like prices go up, right? We see this in uh, our lives every day. Prices are always increasing. Okay. And so, back when I was a kid and I was using my dimes and quarters to buy a candy bar, like that means that my dimes and my nickels and quarters, they were able to purchase, more with that lower amount than they are today. And that's what we mean by time value of money. Your money is worth more right now. So the question or the answer to the question about whether you should take a lump sum versus payments over 20 years is the idea that if you can invest the lump sum today of your lottery winnings, right? If you can invest it in such a way that it's going to grow over time, right? Then it's better to take the lump sum today because of what you can do with that money. Now, here it's called time value of money. As you can see on the sheet, it says time value of money is one of the most basic fundamentals in all of finance. And the underlying principle is that $1 in your hand today is worth more than $1 you will receive in the future because $1 in your hand today can be invested to turn into more money in the future. Additionally, there's always a risk that $1 that you are supposed to receive in the future won't be paid to you. So there's always risk involved. So again, this is as it says here, it is a very like foundational uh, uh, what's the word I'm looking for? Concept in finance. We're going to apply this to current prices, okay? It's not going to work out perfectly because there's so much more to analyzing the stock price. Okay. It's not going to work perfectly, but we can get a sort of like we can figure out whether a stock price is good today. And we can also sort of give ourselves a range like, oh, well, if it's $50 under or $50 over or $100 above or below what we find, it's probably in the right range because it is, in fact, a very fun, like finance is like yeah, the principles have been the same for a long time. Accounting is like older than finance, right? Accounting has been established for like hundreds of years as like a formal discipline. Finance is newer. And so again, it is a basic way to value to assess whether the price of a stock is good or not. And it will not be perfect. There's too many things that make the question, like so much more complicated. But at least, like I said at the beginning, this is about giving you some basic tools to use to apply, this not just accounting anymore and business decisions per se, although analysis was absolutely about business decisions. But this talk today, this lesson today, is really about, hey, like if you're interested in this, like here are some basic tools to walk away from. It's also, a business math topic, so we put it in business math. Okay. In economics, it's a little bit different, but we call it opportunity cost. So it's related, but it's not exactly the same because of the future potential gain that you would have when it comes to finance. But in economics, everything in economics as a study, it's considers what we call opportunity cost. And opportunity cost is, whatever you lose out on based on a decision to do something else. Like you have options, and if you choose one options, you miss out on something else. So you choose to take this class. The opportunity cost of taking the class is maybe some earnings you could have received if you had got a job anywhere, seasonal job at Macy's or whatever, right? There's always, when we choose one thing, we miss out on something else. And so it's very sort of like tied in all together with finance, accounting. It's all sort of business. Okay. So let's take a look at how this actually works. Here's an example. Suppose a friend offers to pay you $1,000 today or $1,050 1 year from today. The promise comes from someone that you trust very much. Remember, confidence. It's about, the whole market is about confidence. So this is from someone you trust, you have confidence, so you don't believe there's any risk that you're not going to be paid. So which offer should you accept? Should you take the 1,000 today, or should you take 1,050 1 year from today? So it really depends on the return that you can earn on that money. If you can earn 6% on your money, for instance, then you should accept the 1,000 today. Because if you invest the 1,000 for 1 year, then at the end of the year, you'll have $1,060. 6% times 1,000 is 60. So 1 year from now, you'll have 1,060. And that's better than the option of receiving $1,050 1 year from today. However, if you can only earn 4% return today on your money, you should accept the offer of $1,050 paid on a year from now. If you accept $1,000 and invest it at 4%, it will only grow to $1,040 in 1 year compared to receiving $1,050 after 1 year from your friend. So that's an example of whether or not it's the right decision. It's what can you do with that money today? Can you invest it such that the gains in a future period of time are greater than what you can do with it today? That's the question of the lottery winnings, and I suppose the answer for $20 million is probably somewhere in between, right? Like, okay, I'll $20 million, and I'll pay the tax on it, probably about 33%. So you got, you can take out, 60 million, you get 140 million, $140 million. You decide you're going to keep 100 million of it and then invest 40 million, something like that, right? Like the real answer is something in between. Okay. So oh. Mm-hmm. Katerina, I'll talk about what I think about that in just a second. I'll talk about that. I have opinions on that man, Robert Kiyosaki. Okay, it's a good book. It's good principles, but I have something else to say about it. Um, one sec. Okay, so in reality, if you really had $20 million, or what was I talking about? 100? Was it 20 million, 30 something percent? Okay, so 6, so 14. I don't know why I said 140. 14 million was my example. I was off by $100 million. Okay, so $20 million, you pay your taxes, you get about $14 million. Maybe with $14 million, you keep 10 million, you invest 4 million. Okay, maybe so the answer is somewhere in between, right? Okay, so we have a little formula, okay? And it's going to be this right here. It says the underlying principles of time value of money are used in finance to value investments like stocks and bonds. So here is our formula. PV equals FV divided by 1 plus R to the nth power, okay? PV stands for the present value like of your money, like that $1,000. Future value is how much is that going to be in the future? R is the required rate of return. Your rate of return, we can just say rate. In finance, that you'll see it out there a lot as the discount rate. Remember, I told you there's so many things in analysis that I really feel like whoever created these rules made it so confusing so that only certain people can know how to figure it out. That's just my opinion. I'm like, that's why I'm always trying to give you like an analogy or like, okay, what does this really mean? How do we say this? I'm always trying to give that to you because if we just look at formulas and information out there, discount rate, like discount, like I would never associate discount with a return. Right? Like I just wouldn't on a basic level. Now, when I really start digging in and learning about stuff, then I understand why it's called discount rate, but it takes a lot of time for you to be fully invested in learning, right? So just rate, like the rate of return. You might see discount rate out there if you're in your business news and business investment videos on YouTube or whatever sites you're on. It's just the rate of return. So don't try to think too hard into it. Just know that it's that. And then N is the number of time periods before you actually get the money back. Okay. So suppose you have the opportunity to invest and you believe that the business will improve over the next 4 years. It's going to pay you annual dividends of $2. And then after that, you believe you're going to sell it for $40 per share. You want to achieve an annual rate of return of at least 15%, which is very high. Okay, very high. How much did you pay for the stock today, assuming that you require or like you want to make sure you get 15% return? All right, so first thing we're going to do is lay out our cash flows. These are considered our future values. And the future values are going to be the dividends that the stock pays us every year. So year 1, we get a $2 dividend. Year 2, we get a $2 dividend. Year 3, we get a $2 dividend. And year 4. In year 4, remember it says that we're going to sell that stock for $40 per share. So if we plug it into this formula, okay, PV, or the present value, is $2 divided by 1, that's the formula, plus 0.15, that's 15% rate of return, raised to the nth power, okay? And the N will be whichever year. The N for the first year is 1, N for the second year is 2, N for the third year is 3, N for the fourth year is 4. Okay, but the FV changes because we're saying that in the fourth year, we're going to sell it for $40 once we get our $2 dividend. And here are all the present values. We're going to open up Excel in just a second, okay? But Excel is going to spit out these values. And the sum of all of those is $28.58. So the answer, okay, to all of these PV, present value, this is telling us that that's the price we want to pay for the stock today. It says if our assumptions are correct, and we'll get to this in a second, because I understand that we're making a lot of assumptions. We're assuming we could sell it for $40. Right? We're assuming that. And we're assuming that we can get a 15% rate of return. Those are assumptions, and we have to make educated guesses on that in real life, okay? And we will, but hold on. If our assumptions are correct about the dividend and the stock price, and I'm sorry, about the dividend the stock will pay and its value will generate 15% of return on our investment in this stock, provided that we do not pay a penny more than $28.58 per share. So that's the price we want to pay today. This is a way that we can figure out how much we should pay today to ensure that we receive that rate of return in 4 years. And we're using short periods of time here because, typically you want your money to come back in 20 years or whatever, right? But it's just a short-term measure. And that's why we can't apply it fully, because we're going to apply it to some stock prices in here in a few minutes, like real life stock prices. We're going to use 4 or 5 years. It's not realistic because we would want to have it in there for longer, 10 years, 20 years, right? But we're only going to do 5 because that's for that reason our estimate is going to be off, right? If we do 5 years and we really want to leave it in for 20 years, we have to take that into consideration, but we don't want it to be so off. Okay, that's why it is a basic fundamental way. You could do it for 5 years. You could make an Excel spreadsheet, no, 20 years. You could do a spreadsheet for 20 years and see how much you want to pay for it. That's entirely up to you, but we're going to do a 5-year. Okay. So here's another example. This company is going to pay $3 dividends, and they're going to be able to sell the stock for $60 per share. They want 12% rate of return. How much should the price be today? So when we plug this into Excel, let me start opening Excel so this makes more sense. Okay, we're going to, let me just, hold on. Wait, it's moving. Let's go like this. Let me just do it like small on this page here. Hold on. Okay, so there we go. Okay, so this is how I'm entering it. Start with the first year. Okay, so the present value is, so let me go like this. Year 1, year 2, year 3, year 4. Okay, if you're wondering why are we choosing 4 years, because I don't want to do 20, because that would take too long. It's just a snapshot, okay? Now remember, not all companies pay dividends. Not all companies would pay dividends, so this wouldn't even be necessary, right? You could just do the ending price for future value one time, but some companies do. So that's why we're doing it. Okay, remember, in the 4th year, the problem is saying that we're going to sell it, or we believe we can sell it. That's a big assumption. We got to figure that out. That has to do with percent change, okay? We can figure out what to expect in a future period if we can take a look backwards at the previous period. It's an estimate. It's an assumption, okay? So we've done our homework. We believe we can sell it in 4 years for $60. So we're going to do all the present value. So you enter it as equals, okay? And the future value of the first year is 3 because that's the dividend. These are the cash flows in all of these years. And this idea is the sum of all the cash flows. The sum of the cash flows will give us our present value. So 3 divided by parentheses 1 plus the R. The R is the rate of return. So 0.12. Okay. I could also do 1.12. I'm just putting it here for to be explicit. Okay. Now from here we need to do our exponent. Okay, for the n. And so the exponent, you're going to do shift, and it should be on your number 6 on your keyboard. It's a little caret. We call that a caret. Okay, so shift 6, the number 6 on your keyboard, and you should get the caret. And then the first year is simply 1. Okay, and I should get what we see there on the screen. on the page. 2.678571. There we go. So I'll do the same for the second year. 3 is my cash flow divided by 1 plus 0.12, which is the formula 1 plus R, caret, and then the second year, the N is 2. These are annual dividends. Okay, annual dividends. All right, I should get what's on the screen there. I get 2.391582. That's the same as what you see on the page, and I'll continue. If you want to just do 1.12, that's fine. I'm just showing it for everyone to plug it into the formula. You can put 1.12, that's fine. All right, year 3 is 3. 2.135341, so that works. Now in the last year, remember we have a different cash flow assumption. We're assuming we're going to sell it, we get that dividend and we sell it. So our cash flows are $63. 60 for the price we believe we can sell it for, and 3 for the dividend. So now we're doing equals 63 divided by 1 plus 0.12. Okay, exponent to the 4th power. 4.03764. So what you do here at this point when you're at the end, oops. Okay, just add up your costs, add up your present values. You can use this little tool right here, AutoSum. Okay, see on your home tab all the way to the right in the editing group, you have AutoSum. You can hit that so you don't have to enter really anything. It's going to know which numbers to choose. And we get 4723. Okay, so using this procedure, whatever you want to call it, you're giving yourself like an estimate, but the meaning would be we don't want to pay more than $47.24 today for the stock, if our assumptions are correct. What are our assumptions? The assumptions are a 12% rate of return and selling at 60. Okay. The exponent, you get an exponent with the shift key and your number 6 on your keyboard. It should have a caret, this little symbol like that. Shift the number 6 on your keyboard. Okay, so we're going to apply this to like real life companies in a second, because it's hard to figure out those assumptions. You're like, how do I know what the rate of return will be? How do I know what the stock price is going to be? They're just estimates. That's why this is not a like, oh, this is exactly how you price a stock. No, it is a baseline measure, and I guarantee you it's not gonna be perfect. Meaning that the answer, like what we find, the stock price is probably going to be more than that, because we're saying that we don't want to pay more than $47.24 today for the stock. But what we're going to find when we actually, use some real life examples is that all of the stock prices are going to be higher. And that's fine. It's just kind of like and again, we're looking at 4 years. Typically, if you want to invest in Amazon, Costco, and all these things, you're probably going to leave them in there for longer than that. So of course the answer isn't going to be right. Like, it's not going to be perfect, but we should give a plus or minus of like, I would say personally, I would say up to $100 plus or minus. Okay, if it's under, great. If it's over, give it $100 over. Even a little, possibly even a little. If it's like hundreds of dollars over, it's probably overpriced. Again, no one thing tells you whether or not the stock, is it's going to give you gains or not. It's all a risk, right? That's why we put all these financial ratios, financial analysis, PE ratio. Oh, good question, Jasmine. We're going to research that. We're going to just research whether the company pays dividends. Okay. Okay, let me talk about Katerina's question about many people probably have heard of Rich Dad Poor Dad. It's sold millions of copies for Robert Kiyosaki, and he goes on podcasts and he does lectures, and that book is basically, you know, how to think about it, and it's like your perspective, like, oh no, we should save money versus, oh no, let's risk the money, right? And it's a good book. I've read some of it. Didn't read all of it. I started reading that book, and something about it was just like it didn't feel like realistic to me, and or like applicable to me. And then I just started going on YouTube and just watching a bunch of his videos, which are also very popular. And what my personal opinion about that concept of Rich Dad Poor Dad, and if you haven't read the book, I'll just tell you, he basically talks about borrowing money to purchase, other things that are going to have a return on your investment, like borrowing for a loan and buying a property. And now that property, you're going to have a renter, and the renter is going to pay that property. So, and then it's going to appreciate. So now your net worth is more. Now your net worth is more. You can borrow more. He talks a lot about borrowing, and then having basically other people pay for it, amongst other things. That's not just the whole part of the book, but that's one of the ideas behind what he's thinking, because you have to think in a certain, you can't think like, oh, I got to save all of my dollars. That's kind of like the poor dad thinking, like, oh no, we got to scrape together our pennies to save money so that we can purchase something, in the future. And he talks about Rich Dad, which is like, no, let's invest in this, and it's going to have gains in the future, right? That's generally the idea of that book, Rich Dad Poor Dad. Again, millions and millions of copies sold. And it's fundamentally, it's a good book, and fundamentally it's, the concepts are, people can apply them, and I'm sure they have. When I So my opinion on that book, Katerina, and just everyone, is that I feel like something in me told me, like, because I listened to, like I told you, Warren Buffett, or, I listened to like Steve Jobs, like I listened to these people, and um, I feel like with him, I can't help but feel like, well, it's easy for him to say that because he has those resources, right? Like he has resources to go and buy that home or that property or that fixer upper. Like he has the resources to do it. So if you don't have the resources to do that, or you're not in a position to do that, how can you really do it? Right? If so, and it applies to buying stock or going, opening up a SoFi or a Robinhood. You should have, if you have the money to do it, then go ahead. But if you are struggling, you know, to put food on the table and to pay all your bills on time, I don't know that that's the best decision. You should probably pay down your debt, right? So that's a key piece to his whole philosophy that personally I I don't like that. I don't, he should say, like, if you're in a position to invest, then here's what you do. But saying it broadly, like everyone should do this, I just don't think that's realistic. So if you have the funds, you know, to start investing, then of course you should. So Katerina, you're saying you want to buy stocks, he doesn't want to. Um, you don't have anything to invest, but you want to try. That's kind of my point. You need to have the money. So let's see, you've been on maternity leave for 4 years. Okay. I would look into any kind of work that you can do remotely from home, Katerina, part-time, part-time, if you have children and, you have to, be home. Um, I would recommend looking for remote work online and making, gathering trying to get some money for yourself to be able to do that. And again, that's only if everything else is paid, like I personally, I do okay for myself, but my husband has a disability and he doesn't make that much money, but he pays the insurance and the insurance is so expensive. So his job is really for insurance. So it's kind of like his actual pay it's not a lot. And so even though I do okay, like he doesn't, and so or he does. It's very valuable, of course. And he works really hard, but he's just not able to make more money because of his disability. And so, but it's important we have the insurance because he needs treatments and the insurance pays for his treatments. So it's all part of like the whole thing, right? So my point with myself is that I'm always having to save money. I'm always having to save money for, oh, our car needs maintenance. We need new tires. The kids need new clothes. The back to school shopping. The kids have a, trip coming and like a school trip I have to pay for or piano lessons or like I have to constantly save money, right? So for me personally, it doesn't work for me. Like I can't just take my money and start investing it, right? Like I'm not in a position to do that. You see? Like I've tried the Robinhood and SoFi and I have a couple $100 in there and I see what's happening and then all of a sudden, you know, my husband got in a car accident. We have to pay $1,000 deductible. Like I'm always trying to save money. So it's just all of this is tools for you, like if you're able to. And same thing with Rich Dad, Poor Dad. Like you have to have money that you don't need for something to be able to do this, right? Because I see this all the time, people on social media or whatever, and they're in a bad spot. It's this thing that's people keep saying lately, like we are all like one, getting fired from a job. Like everyone is in this economy, talking about our personal households, like one job away from being in a really bad financial spot, being in a if something happened with my husband's job and then he needed treatments, like I don't know what we would do, like I don't even like it's so hard. So all of this is, this analysis and giving you tools to be able to make good decisions. Make sure the first step should be, do you have the funds to do this? Like, is your money, you know, able to get you into this world, this market, right? That's why having a job with a retirement account, which I do, which my husband does, like that's enough for us. So I keep track of the market because I want my retirement account to be okay. Like I want to see it, I want to see my quarterly statements grow. So I pay attention because I'm like, okay, the economy's okay. These big guys are doing okay. I'm fine. Like that's all the investment I can do. I contribute to my 401k, my employer matches it, and I have, it's or a retirement account, right? Which is great. But I don't really have like I don't have money to be spending in the stock market. Every now and then I try, and then some kind of expense comes up. It doesn't work. But that's what my suggestion would be, Katerina. Find a part-time remote work from home job. Look at being an assistant if you're good at computers. There's a lot of virtual assistant jobs, but regardless, get something you could do from home and get a little money pot of money for yourself if your husband doesn't want to, and use that to start investing. That's what I would recommend. But as far as that book goes, uh, same as what I'm saying. Like it's easy for him to say that because he has the resources, he has the money to go buy a house, and then now your net worth is higher, so the bank's going to approve you for another loan. Now you have 6 properties, and all the people are paying for it. Like that's how he talks, and it's like I can't buy a house, like, and the bank's not going to give me a loan to buy a house. So what are you talking about? You know, and that's not poor dad thinking. It's like it's the reality of a lot of people who have to save money and who maybe have debt. You know, I don't have credit card debt, but I have our cars are so expensive. Oh, I hate it. I hate it, but it is what it is. Like the cars are probably my biggest like thing. I just can't believe how much they cost. And that's a whole other story. I don't have to go into that, but I'm just saying, if you have the money, these are tools you can use. And if you don't have the money, you know, look into getting multiple jobs to get a little money pot going. All right, let's apply this to real life. And for this, let's go back to Jasmine's question as far as dividends. Okay, and so the first thing you want to do is look at whether the company pays dividends or not. If they don't, it's actually a bit easier because you don't have to do all the cash flows, right? You just have to do the final year, okay, and use that as your future value. Okay, so I'm gonna go with oh gosh, what's it called? I'm gonna go with
Yes, the capital gain is considered also an income, right?
yeah, at the time when you sell it, yeah.
Oh, not sell it, no gain means no
You don't have
tax.
to pay yeah, you're right. As long you don't have to pay unless you sell capital gains tax unless you sell. So if your money's in that, that's the idea of the market. We want to keep it in there, right? We're trying to avoid paying those taxes because if you do make money and you sell it, now you have to pay capital gains tax. That's right. Okay, so I'm going to go with a company called Sherwin-Williams. And this is a paint company. And let's see, do they pay dividends? Okay, so how much dividends do they pay? They pay about 1%, which is so it says for every 100 invested, investors receive 96 cents. So like $1, you know, an average of $1 of dividends. All right, so let's use that. Payout ratio is 30%, which means that 30% of the company's earnings are paid out as dividends. Okay, so we have that here. Sherwin-Williams is SHW. Let's go here, SHW. So we're going to do this for Sherwin-Williams. So we need to understand if we're going to do this for Sherwin-Williams, okay? We know that the dividends are $1, and we're just going to round. It's an estimate anyway. Let's go to how frequently? Let's see. Oh. Let's see, how often do they pay dividends? How many times do they pay it? Let's see. Quarterly. Quarterly $1. So if we do an annual, we could do $4, right? This is older, but it says currently it's a dollar, like 96 cents. I'm going to say $1. If it's a quarterly dividend, dividend is $1. So let's just do it because this thing works for the year. So we're going to say $4. Okay, $4 a year. Again, it's estimating. All right, so that's that. Now we need to know a couple of things. We need to know what do we require? Okay, that's the interesting wording here, but it's the right word. What do we require as a rate of return? Okay. What do we require? Like what should we expect in, we'll do a 5-year, okay? Now, there's so much in this that is estimated that I do not want anyone to think this is exactly how to price. I keep saying it, but I want you to know it's true because the dividends could change over the 5 years, right? That's another reason why I only do a couple years. You know, it's just a very basic and general estimate. So we'll do a 5-year for them. Year 1, year 2, year 3, oops. Year 4, I'll fix it right now, and then year 5. And again, we don't know if they're going to keep paying that dollar every quarter. It could change. Okay. And so here, our future value, we're just going to use 4. 4, 4, 4, 4. And the last year we have to figure out how much do we expect to sell it for. These are our assumptions. These two are our assumptions, okay? Okay, so we have to try to figure out, like, what should we expect as a rate of return? How much do we expect to, not see, but to sell it for? Hold on, sell. Okay, so first of all, what is wrong with me? Hold on. Those are ones. L. Okay, so first of all, expected rate of return. Okay, let's ask the internet. Average rate of return on stocks over let's look at the last 10 years. That's fine. All right, so the average, let's see. Over the last 10 years, the average annual rate of return for the S&P 500 has been around 12%, depending on the exact date and so on. So S&P 500, these are platforms where you buy and sell, okay? And you have the Dow Jones and the NASDAQ, right? So S&P 500 companies, and you can look up what those are, 12%, Dow Jones, roughly 10%, and then NASDAQ, closer to 16%. So somewhere in here, I think if we were going to choose the 30 years, it's probably lower because I saw that pop up. Yeah. See how in the 30-year mark it's not 9 to 10. Adjusting for inflation, that brings it actually closer to 7 to 9. Okay. Now, as long as I've been teaching this class, I've typically used an 8% rate of return because that's what's realistic. Okay. Over 30 years. Now, in our assumption, we're only doing 5 years. So again, it doesn't make a ton of sense to say, oh, well, 9 years, right? Like we can go higher if we're kind of estimating out for just 5 years. So let's go ahead and take a rate of return based on what we see the history of for this thing. So let's go back over here. Let's go here. Let's look at a 5-year, okay? Okay. So a 5-year, here's 2020, and we're in 2025. 245. See that close? 245. Okay. Let's figure out if we can see what the percent change is and make a what's the word? A general assumption. Maybe even a safer assumption than what we see here. But 245. And now we're in December of 2025 and it's 328. 245, 348. Is someone's microphone on? Yeah. Okay. What is this? I have an ad over here on my other side. Okay. Okay, so this is 2020. This is 2025. Okay. Well, we can find percent change, right? Because we've learned how to do that, right? change. So whatever the increase was over the last 5 years, we can require that rate of return. We can, right? Or we can be conservative and go lower, right? In our estimate, it's all an estimate. It's not gonna come out perfect. Let's see. So we know that to do percent change, we take the new number minus the old number, and we divide by the old number, right? That's our percent change. 42%. Okay. Now, I wouldn't, that's so high, right? We just looked at the 10-year, which was about 12, and that's an average, right? And then we looked at the 30-year, and it's really between 7 and 9. So if we're going to be optimistic, I mean, gosh, there's just no way I would expect that over the next 5 years. I just wouldn't. Like we don't know. That's not a safe assumption. Okay, that's a very, very ambitious assumption. What I would say is that we can probably go with the higher end of all of the rates that we just Googled. And the highest of what we saw was about, what did it say? The NASDAQ was about 15%. So we can choose 15%. That's fair. Okay. It has changed 42%, but I'm not willing to, remember, we're looking over 10 years, 20 years, like realistically, even though we're only going to map out 5. Okay. So based on that, I'm going to say that we want a 15% rate of return. Okay. So there we go. It's kind of like a guess you have to make based on the average rate of return in the market, generally or broadly speaking. And the highest one we saw was 15%. I'm willing to go 15%. Okay. Maybe it'll be more, and that'll be great. That's actually a good thing. Like if I anticipate 15 and I actually get 42, that's wonderful, right? Okay, so there's that. We're going to say 15%. How much do we expect to sell it for? Okay, well, today it's 348, right? So what if we tack on 15%, right? We can tack on 15%. So 348 plus 15% of 348. That makes sense, right? Like that's what we want a rate of return of 15%. So if we tack on 15% to the current price, that's the ballpark where we want to expect that we would sell it after 5 years. Okay? Ask me questions if you need to. Okay? If I'm looking for 15%, then I can tack on 15% to the current price. And that should give me a rough estimate. $400. So the future value, if we plan on selling it for 400, then our future value is 404, right? The dividend plus the 400 I expect to sell it for. Okay? And then we start doing our present value. In the problems that you're given in that quiz, I don't ask you to go research yourself. You're given all the information. You will be given a rate of return. You will be given how much you expect to sell it for. You'll be given a dividend. So you don't have to go research, okay? All you have to do is map out your cash flows and insert the formula, okay? And then the sum of your present values will be the answer, all right? This exercise is just like, how could you, try to do it in real life? And the assumptions are really difficult for us to to know for sure. Okay, so we'll just see how it works out. All right, so this formula is, let me write it over here. So PV, present value, is equal to future value divided by 1 plus R to the nth power, right? So that's the formula. So that's what we're going to enter. Equals 4 divided by 1 plus 15%, so 0.15. Okay. Use the caret for the exponent, and the first year is 1 year. Okay, next year. 4 divided by 1 plus R, or 0.15, raised to the second power. Caret 2. Right, third year, 4 divided by, lots of assumptions in here. We don't know that it's always going to pay the dollar dividend quarterly. That could change. 1 plus 0.15, oops, to the third power. Okay. 4 divided by 1 plus 0.15. The year is 4. Did I do year 3 here? Hold on. I did. Okay. And then finally, in the last year, this is equal to 404 divided by 1 plus 0.15 and the 5th year. Okay. All right, enter. Okay, so the idea is that the sum of all of these future values is what we don't want to pay more than. 212.28. We don't want to pay more than 212 today for this stock with these assumptions. Okay. All right, so we take this thing and we go over and see how much it is today. And today it's 327. Right? So today it's 327. Like in reality, today, I know we're almost done. On 12/16, the price is, I'm sorry, I already forgot. 327. Okay. So remember what I said. So let me be clear. This is what you have to know for this class, right? For the assignment, for the test, not the assignment, the test, this is what you have to know. This stuff in here. Okay, so if you're just concerned about what the question will be on the final, it's this. And this will be your answer. Okay? That's it. And maybe I might ask you what it means. And so you want to say that. As far as the test, that's it. That's the whole thing. And you're done. And you'll get the answer right, provided you enter in the formula correctly. Okay? Now, side step 2, if you could really use this in real life. Assumptions are hard, like I said. I would not say 42%, but you could map it out and see if you can get 40% in the next 5 years. You could do that if you want to. Go ahead and do it. Go ahead and put 40%, see what happens. See if you're in the ballpark of the price, because the price today is 327. Remember what I said earlier. In real life, I would take whatever I get plus or minus up to $100. Remember I said that? So I think this is a good price because we're looking at a 5-year when in reality, we would want to invest for 10, 15, 20 years, right? So that if I mapped all that out, which you can, go ahead and do that for on your own. I'm trying to give you tools for real life here today. Okay. But I would say in reality, whatever this comes out to, and based on my past like 7 years doing this, it's pretty much plus or minus up to $100. Obviously, if it's under, and I promise I'm done. You look at your PE ratio, it's nice and solid. You look at your earnings per share, nice and solid. It pays out dividends, that's good. Look at your 5 year, some lows over here, but overall it's done well. All those things together, plus the price of the stock, plus or minus my answer to a 5 year under these assumptions, I say it's a good stock. Does that make sense? Okay. So the assumptions are what we are not experts at doing, but we can take a look at the past to predict the future. Excuse me, to predict the future. We know how to do percent change. We can figure out what, amount we believe that it could be sold for if we were going to sell it. Just tack on to the current price the rate of return that you're looking for. So those are very general and basic assumptions. But if we were better at assessing the assumptions, this table would even be better. Okay. So because we're not experts at the assumptions, we could only take maybe a percent change and tack it onto the current price to find what we could expect to sell it for in a given period of time. And because we're only doing 5 years versus 10, 15, or 20 or more, we can take our answer and tack on $100. And that's pretty much when I've done it, and I've done $100, it's always in the same area. When I've done Nvidia, I've done Home Depot, you could do it with whatever. Now, when you start to get $300 over, $400 over, and you look at the chart and you see there's reds and it's very volatile and the PE ratios like, 100 something and the EPS is $2 and the dividends are nothing. Now it's like, wait. This probably isn't a good stock, like all the pieces together. Okay. Well, like I said, what you have to know, we talked about a lot of things today, but all you have to know is how to do this. That's it. Just this stuff right here. Okay. As long as you can do that, that's all you need to know. I just wanted to provide you with additional information, some of the basics that we should understand leaving this class to apply to real life. On Thursday, we'll talk about interest, a couple little things in payroll. I just want to show you QuickBooks actually. And that'll be it. We got one more day. All right. We can do another practice problem of this if you want on Thursday. Just let me know. But other than that, you're free to go. Thank you, and I'll see you on our last day of class Thursday.
A question about disaster event, like there's something in April or like the Great Depression, something like similar events. So how to consider those things?
Like I said, I think that that's why earlier I was looking at all the big companies. Keep an eye on all the big major companies as long as they're doing well, because they have investors not just from the average person like us, but from other multi-million, multi-billion-dollar companies and other countries. There's a lot of investment from all over the world in those companies. And so when I look at them over a period of time and everybody's doing okay, like everybody's doing well, I'm not concerned with like a Great Depression. I think that it's really, about like we were talking about earlier, how we have like our own personal economies within our homes. Like it makes us feel like worried, like, oh, everything's so expensive, things are getting bad, right? But that's why I wanted to separate, like, that's a different economy in our households, which are important because we're the ones that go out and spend our dollars. But what we don't want is for if the larger economy fails, we're all finished.
Oh,
And that's
okay.
a Great Depression. But the
Um,
individual level, it's just, you know, it's hard, but you can't base the global economy on our individual households because we do have different, you know, people making different amounts of money. That, you know, we got the millionaires and billionaires, but they also employ people. So sometimes in our little orbit, we don't, like, I don't know any millionaires, you know what I mean? But there are, you know what I'm saying? So, and those people, we want them to do well because they have employees. And the employees, these are people buying stuff, paying taxes. And so in the bigger picture, as long as they're doing well, we know there's people working for them doing well, and that's important to the broader economy. When it comes to us, you know, we live in a very expensive state. We're taxed like crazy. We pay crazy gas prices. We pay crazy insurance prices, right? So that's just for us. If we want to live in California, we better get, you know, our certificates, education, you know, make more money. We just got to make more money. All right. So I wouldn't worry about a Great Depression right now.
oh, I see.
Hmm. Okay, everybody, thank you. I'm going to end the recording. Thank you. See you.